Most traders believe world-class performance comes from better setups, better indicators, or more screen time. I believe that too, until I broke Larry Williams' world record and made 11,500% in just 4 months. But here's the part nobody talks about. It wasn't a secret entry idea. It wasn't indicators. It was something I call scanning. And it completely changes how you see the market. Okay, let me give you some context before we go any further into the lecture scanning. I just want to be clear about it that this was on a paper account. Everything you see here is not on a real account. I'm not licensed to do so. That is why I'm using this one. But the people who followed me in the mentorship, they know I called these levels beforehand, and I did some market reviews and trade breakdowns on these kind of trades to show what's possible with a simple approach to the market and having only one entry technique. That was, in my case, the fair value gap. So you can see I started on a 100k account. I focused more on winning trades and did pyramiding into them to reach the maximum out of that. So you can see a lot of winning trades here, and the win streaks are huge compared to the lose streaks. You can see running it up to here, 11.6 million. So that is a gain of 11.5 million, and that equals to 11,500%. That result didn't come from trading more, spending more time on the charts, or going all in. It came from seeing the market differently. Scanning is something you definitely want to do every day, and to understand the price action behavior. Because if you put in an indicator on your chart, you're not reading what price is doing right now. You're reading an indicator that has no impact at all on the price action. Instead of doing that and try to get the next big thing in the indicator game, you just try to understand what the market is actually doing. It's actively thinking about what is the market leaving, where is it going, where might it reach to, and this is what you definitely want to do every single day, every single session before you start trading. And the very first thing would be, where are the smooth edges? And smooth edges are basically equal highs and equal lows. You can find them on every single time frame. It doesn't really matter what you're looking at. It can be a daily, 1 hour, 15 minute, 5 minute, 1 minute. These are my main time frames. And the second part is, what key levels do we have near the price action, and where is price coming from? This is what I scan for every single day, every single session. Because if you don't do that, you have no idea what the price is actually doing. You won't understand why it's leaving some kind of liquidity or imbalances, and also the characteristics of price. Because if you just purely do it on external things, like indicators, like the book map, other things, right? If you do only that, you will miss everything price is leaving on the chart. So the first thing, as I said, smooth edges. And that is basically something you can train on hindsight price action. You want to do it as often as possible. And in this chart right here, I can see thousands of smooth edges. And that is what you should look for as well. It might be a lot, but if you scale it down to lower time frames, it makes more sense. For example, on the 1 hour chart, if you look at this high here, right? This one here, that's buy side liquidity. Why is it buy side liquidity? We have a high here and a high here. So this is relative equal. This is smooth, right? So retail traders have the buy side order above that as a stop loss or as a breakout. And you can see by this move here, it trades into the stop losses, or it traps these people who are trading on a breakout into going long, and then quickly retraces into an imbalance. So that is something you definitely want to watch out for. Smooth edges, and do it as often as possible. Find as many examples as you can, and this gives you a pretty good roadmap to what price is actually reaching for. So this is how it looks like when I mark up every single equal high or equal low, and this is only on the 1 hour chart. So you can see this low here with this one is relative equal. This one with this one is relative equal. These are relative equal, and so on. I would say you should train this at least for a few months, every single day, 30 to 60 minutes. Just look at hindsight price action. Look for these smooth edges. It will definitely help you in live trading because it will give you a bias, first of all. And secondly, it will give you a drawn liquidity you can have confidence on. Because if you then try to time your entries and everything, and you understand the narrative on the lower time frames, you have a draw to hold for and scale in if you have a winning trade. So this gives you a lot of confidence in holding your trades and not taking out the profit too early. And you can see how price is going to reach for these kind of levels, right? So for example, these highs here, price makes the lows here jagged. Jagged means basically if you have a low lower than the left low, or in buy side, then the right high being higher than the left high, that is being jagged. It's basically the opposite side of being smooth, where you have the right high being lower than the left one. This is considered as buy-side liquidity. Quickly runs away from that. So this is engineered buy-side liquidity. When it comes to that swing high here, stops right about there and then quickly drops. Then it trades higher, consolidation, building up more sell-side liquidity, trades into the buy side here, makes the highs jagged here, trades into internal liquidity, and you can see these wicks in here, they are also relative equal. So on the lower time frames, this would also be a sell-side liquidity pool. So it trades there into an imbalance, even lower, these wicks in here. So this is basically, if you scale down to lower time frames, you will see a lot of examples like this. And you can see them on the 1 hour time frame with like looking at the wicks, but that's like more advanced. If you do it more often, you will see it immediately. But if you're in the beginning of scanning price action, then you should go on the 1 hour, look for the obvious ones, go for the 15-minute, look for the obvious ones, and so on. So you can see it trades into the sell side here, trades higher, leaving some sell side here, and this is a trendline phantom. As we know from retail trading, they look at this as a trendline basically. And in the middle of that, we have the most sell side liquidity. Yeah, and it trades there. So that is something you can also look for. It trades here, goes higher, leaving buy side again. So that is engineered. Trades lower, leaving the sell side here, also as engineered. Traps the people who are trading a breakout or who are already short here and have their stop loss orders up here. Once more into that with the wicks. So the wicks are doing the damage and trading above that buy side liquidity again. Trades lower and then comes with displacement lower with a fair value gap, trading into the sell side here and here, and then so on. You can see it trades back up into equal highs, into a premium from this side to this low. We are in a premium. Engineered sell side liquidity here, then trades higher into an order block, and then quickly runs for the sell side liquidity. Also on the 1 minute chart or 15 seconds, you can do this. Try to get as many examples, and then once you have that, you can go scale in and add some other things. For example, what key levels do we have? And that is basically the second step of scanning. So I already made a video about key levels. And in this video, I'm using only the new week opening gaps to explain what I mean in having key levels near price action or also above buy side liquidity or below sell side liquidity. So you can see all these smooth edges in here. And we are trying to add some kind of key levels to that, either as a target above these smooth edges or below, or as a catalyst for your entries. For example, here, the buy side liquidity, the next key level, there can be something like a new day opening gap, a first presentation, something like a fair value gap or whatever it is. But in this, for example, we take the new week opening gaps. So in here, for example, in this price action, we have the buy side liquidity, the sell side liquidity. Below that sell side liquidity, we have a new week opening gap. Above that buy side liquidity, we have another new week opening gap. And in between, we have also one. So you can see it trades at that new week opening gap, leaving the sell side and buy side liquidity here. First, trades down into the sell side. How far can it go? New week opening gap. That's a key level. Leaves a fair value gap here. Trades into that as a key level resistant point and trades lower. So that can already be a catalyst for your trading idea. Trades above that here. Then trades once more into that high here. Breaks down. Then the bodies are here respecting that key level into the next new week opening gap with a high. Bodies here respecting that, leaving the engineered highs. Trades lower, leaving another new week opening gap for later. Makes the sell side liquidity here engineered into this new week opening gap again. Then a order block with a new week opening gap. That is something you definitely want to have as high probability, because if you have a PD array like an order block, fair value gap on a key level, that is something you definitely want to watch out for. And then quickly runs for the buy side liquidity, retracement into fair value gap, order block, and what do we have here? A key level, new week opening gap. So it trades higher into random level, the next new week opening gap. And if you do this more often, you see these kind of key levels, they are respected. You want to read what price is actually doing on these key levels. For example, are the bodies respecting it? Do we have any sell side or buy side liquidity just engineered above or below that? Do we have some PD arrays like order block, fair value gap, breaker blocks on these kind of key levels? And you can then also use them on the lower time frames for your entries. Scanning for what key levels do we have and understand those key levels above price or below price makes it easier to first find the narrative Secondly, find the bias you're trading to. And thirdly, you have an easy way to enter a trade. So you can see it more fluently without thinking about it, just by practicing. It should be second nature. Basically repeats itself. And if you add timings to this on a lower time frame, man, this can be very, very, very precise. For example, this here, if you look at the timing, it's 4 a.m., 5 a.m., 6 a.m. So this is London Open. It trades as a manipulation lower into a random level, that New Week opening gap with this PD raise. And then in the New York Open, it trades quickly and the equity opened quickly into that target up here. So this looks like a mess because it's trading up and down, up and down, up and down. But if you scale it down to timings, to your key levels, to the buy side and sell side liquidity on the lower time frames, scanning for them, everything makes sense. And now the third part is, where is price coming from? Because sometimes you think a bearish fair value gap should always be something to short, right? And that's not the case. For example, if you look at the sell side liquidity on here, and it trades into that with the New Week opening gap and quickly runs away. It trades back up into that New Week opening gap, and you might think, okay, this might be a short opportunity. But that's not the case. Why? Because we are looking for where's price coming from. And we do still have buy side liquidity up here. So first you scan for buy side and sell side. You know where these are located. Secondly, you have the key levels. And thirdly, you ask yourself, where is it coming from? And by understanding that the sell side already is taken, the New Week opening gap, we have a quick runaway with a fair value gap here, displacement into that New Week opening gap and see accumulation. That is not something you want to see as a break lower, especially when you have the buy side liquidity up here. There are some examples where you have this and then it breaks lower, but then you have highs being jagged, for example, up here, right? So these three highs are very jagged, and that is why price is not aiming for that. It's aiming for the internal buy side liquidity. And then you understand that this is a accumulation on the New Week opening gap inside a discount to then trade higher. And you can see it trades higher here, leaves a fair value gap here, trades into that here, and quickly runs for the buy side liquidity up here. It breaks lower from that here. So what is now the question we have? It's the same. Where's price coming from? We have the buy side liquidity up here. We have a New Week opening gap. Trades there. What did the candidates do here? They have their bodies just below that key level. So they're respecting all of this and quickly runs lower. And then you think, okay, this might be bullish order flow trading into new highs, new something else, right? But if you look at this here, it's already jagged. If you look at this, it's jagged. And the only thing that would make sense now is trade to this imbalance. How far can it go? There's an order block. There's a mitigation block. Trades into that here. And then quickly runs for what we already did for the sell side liquidity from the first part of scanning. And this is how you understand the market way, way, way better. You don't need any indicators. You don't need any order books. All this kind of crap is not beneficial for understanding price action. Understanding price action comes actually from the candles on your chart, nothing else. That's everything you need. Coupled with timing, you will have really precise entries. And now, for live price action here, we can do it the same, right? We have buy side liquidity up here right now. So as we are trading here, this high here, we're trading into New Week opening gap. It quickly breaks lower and leaves sell side liquidity right here. So right now we are here, right? So what can it run for the buy side or for the sell side? We do have a fair value gap here, like this. And there can be a key level, there can be a new day opening gap, there can be first presentations, something like that. So it trades there and quickly breaks down into the sell side liquidity. It does not mean that this is not interesting. The buy side still is open, so there's liquidity resting. At some point, price will reach for that. So on the 1 minute time frame, it would look like this. You want to scan for sell side liquidity and buy side liquidity. So your session starts, for example, at 9:30. In here, you see, okay, there's buy side liquidity, equal highs. Mark this, and also this down here. Sell side liquidity, equal lows. It trades into that here. Trades lower into consolidation. And then builds up more buy side liquidity here. And how far can it go above this buy side liquidity? We have a New Week opening gap up here. So it trades into that here, makes the highs jagged. So we have 3 highs that are higher than the previous ones. And then quickly breaks down, leaving sell-side liquidity. So now we can ask ourselves, where is it coming from? It's coming from the weak opening gap. It's coming from a jagged high and leaving a fair value gap here. So it trades into that here, runs for the sell-side liquidity, continues lower, leaves more engineered sell-side liquidity here, trades into order block, fair value gap, into that here, and then the final target would be down here, the sell-side liquidity. You can see it trades below that first presentation, leave the sell-side liquidity, and this can be used then as a key level, trades into that here, and continues lower.